All right, who was the guy who commented? Oh, Philip. We'll see if he's back. Be our number one fan.
See our one loyal, our one loyal commenter. Maybe, like we had some technical difficulties last week.
Hmm.
All right. Now we are live. We are going to post the
All right, who
link
was the
right
guy who
now.
commented? Oh, Philip. I gotta figure out how to open the live stream without it sounding off every time. But there we go.
Yeah,
Okay.
okay. I'm going to post that we're live now. Um, Doing our weekly live stream. We talk about semiconductors, retail, and the revised macro picture. Posting the link would be helpful too. All right. A special Tuesday edition here.
Yeah, nice Memorial Day weekend, and we figured everybody will be back interested in stocks after that nice break we all got. And
Yes, it was very nice to actually find out that I did not have to write my newsletter over, like, typically I start writing it on Saturday and I'll finish it on Sunday. But
mhm.
on a weekend where I get an extra day, I'm like, oh, I'm just writing it all on Monday.
Yep.
And it's really nice. But yes, a lot to talk about today. Obviously, a ongoing crazy market. And one of the things that I think was really interesting last week until I did the numbers, that it was pretty shocking, but you can go and read it in our newsletter. But essentially, if you look at QQQ was up 3.53% last week. But if you take out NVIDIA, Amazon, and Meta, which is 17.53% of that index, it was only up 1.63%. And it's even crazier for the S&P 500, which is those stocks are three of the 500 and makes up about 6% of it. But the S&P 500 was up 0.33% and actually flips down 0.37% if you take
Wow.
those stocks out. So it is crazy to think that like three stocks, I mean, obviously NVIDIA is a big part of that, but Facebook or Meta was up almost 7%. So I was looking at that because obviously Amazon and Meta, for those that read our newsletters, are stocks that we've been recommending for over a month now, for the big reason, and we can't emphasize this enough. One of the reasons we steer people towards those stocks is when there's blue chips that we like, it is just sound risk management practices to say, hey, the Prospero signals like this, you should invest in these. And we've been basically saying and practicing what we preach, mainly trading myself. I've been long, mainly only Meta and Amazon. Uh, so yeah, there is obviously tons of interesting stuff today, like, which is in addition to that, just like the extension, where we're still talking about like, wow, we are seeing this divergence where it is basically you know, semiconductors, AI, like all of that stuff, just like through the roof, and the rest. And as we talk about retail, some of it going the complete opposite direction. And when we talk about the macro picture, I think we are entering perhaps one of the more fascinating market phases, potentially, I've ever seen. And we'll talk about that in the macro. But first, let's dig into semiconductors, which, you look at some of the ones that, I shared an article in my newsletter that was NVIDIA and AMD are now some of the most overbought stocks. So to just lead off and just be very clear, like, I don't think it's a very good idea to play it either way right now. Like, you might be saying, hey, it's a great opportunity to come in and short NVIDIA or AMD, or you might say, hey, these are going to go up forever. Like, I think it's important, and I think not enough people are process oriented with stocks to basically say, like, no, it's not a good idea to do either of those things right now. Nobody has the proper data to figure out how much more can be priced into those stocks or how much more momentum can be priced in those stocks before essentially institutions are going to decide they want to flip the other way and short it and have opportunity and basically have a lot of momentum going the other way, and they really have the power to do that. So yeah, I was gonna say that's thing one. And basically the other thing, I forgot I have my little like light here for these casts that's gonna make it better. That is in addition to that, is that when you eventually take a stock like Nvidia or AMD, that it's just like they've driven away from traditional valuation metrics because there's a lot of speculation and momentum. It's very hard to read those. Like, it's very hard to go either way. It's very hard to bet either way. And I think a lot of people are under the mistaken impression that just because you buy something and it goes up, that it means your process was correct. Or if you short something and it goes down, it means your process was correct, which is like, anyone that knows anything about game theory, stocks, my favorite book is called Fooled by Randomness. And that is just basically talking about, one of the same guy that wrote Black Swan, Nicholas Nassim Taleb. Fooled by Randomness was an earlier book, and a lot of the professional investors think his better book, because he basically talks about how you have to separate process from luck. And a lot of people lose their fortunes because they've essentially just been very lucky. And the story goes like this: like, a bunch of people, just as if you're at a casino, you make money and you keep on betting more and more and more because you think you're really smart. But in essence, you're just gambling more and more and more because you don't have a good process, and you just think you have a good process because you're lucky. And if you look at it like this, some percentage of people, like in any game where you don't understand the probabilities, like blackjack, we know the approximate probabilities, things like that. Nobody really understands the probabilities of the stock market that well, essentially because there's a whole school of very intelligent people that think the markets are stochastic. We actually have a big advisor coming on that was in the C-suite on the technical side of 2 of the 5 largest US banks. And we're going to be able to announce that soon. It's very exciting. But he actually believes the markets are stochastic. And he knows them, better than most people I've ever met. And he says basically you can't predict the markets, even if you're selling at one of the largest banks in a C-suite technical position, better data than any of us get. He still believes that. And then there's obviously people on the other side that are very smart that I also respect, that do believe you can have advantages in the market. So first of all, people can't even agree on that. So when we talk about the probabilities being transparent, we can't even get agreement whether it's possible to beat the market. But throw that aside for a second. I think most of us can agree that retail investors have various disadvantages. But regardless, if it is a function of luck and they are stochastic, there's going to be some percentage of people that just win irrespective of that. So that is why I always caution people to really focus on process and say, is my process right? And there's all the time, especially as I've been doing this for longer, where I'll lose money and I'll say, no, I lost money the right way. Or I'll win money and even say, oh, on the other side, I got pretty lucky. There were some holes in like what ultimately happened. And that's why it's really important as an investor to form what's called an investment thesis, where I basically am saying like, oh, I am looking for the following things to happen. And if the following things happen, like if earnings are here, and if the macro environment stays here, or there could be a bunch of different triggers, or if the market moves in this direction, or the QQQ versus the SPY moves up more, then my thesis is correct, and then I should make money. And that's the important thing that everybody should do. If you don't have a thesis and you don't have conditions, and you're just basically saying, oh, I'm right if I make money, I'm wrong if I lose money, you're missing the most important part of investing, which is process. Which is why I do not like, to take it back to AMD and Nvidia, I don't think there is a good process right now that you could use to say they will go up or down, because there is both so much momentum involved in why they're going up, and also I would say a lack of real value, because we don't really know how big the AI market goes. And even just looking at AMD and Nvidia, that's the crazy part of it. We don't know if the future is more GPUs, where AI is going to be run on them, or more on processors. And AMD wins big if it's processors. NVIDIA wins big if it's GPUs. So that right there says everything you need to know about the lack of actual strong value assumptions in figuring out which one is going to win. Because it could be something in between. It could be more of a winner take all as these models evolve. But yeah, that's why it's very tough to value these. And there's no real good value hypothesis for a market that we don't really even fully understand. Um, and there's a lot that's going to play out. There's a lot that's going to play out about that. And that's a good, kind of transition to more broad-based semiconductors. And if you're looking for a semiconductor name that we really like, we've actually had ASML in our safest picks. We tell our families to invest in these for a while. And all of those picks have been doing really well lately. FSLR, we had Meta has been there for a while. The big one that we also saw was CELH. Now ASML joins them. Those are basically 4 of like the 5 that have been appearing a lot on our list. So that's been a very strong list, and those are good risk-adjusted lists where we prioritize high upside breakout, which is a lot of bets in the long-term options markets, calls, versus puts. Low downside breakout, which is kind of the reverse, where we kind of focus more on the puts than the calls, but still the ratio. And then high profitability. And ASML is the perfect example of a company that I hadn't really even heard of until, I saw it on the list. I did more research. And it's the 5th largest semiconductor stock. As I dug more, I was like, oh, this is actually really interesting, especially because other semiconductor stocks were not valued as similarly to it. So yeah, I think that that's one, if you're still like looking for one that has a lot of upside. That is a very profitable semiconductor stock that already had great profitability predictions without these kind of adjustments that NVIDIA has made and all of these other companies are likely to make. So ASML might be like carried on this, but obviously hasn't seen as big of a gain as NVIDIA. So that might be a really good one if you're still looking to join the party. And another interesting one is that we don't like as much as ASML, but LRCX is a very interesting one because it has a 90 profitability rating for us and a 9 growth rating, which, obviously growth and profitability are going to get updated when companies update their, their future guidance. And this is going to affect, I think, all of these companies' future guidance, obviously semiconductors being an input to chips like NVIDIA. So that's just like in that supply chain. So if they're upping them, like not only is it expected, it's almost required. If NVIDIA is basically saying we're going to be like manufacturing more, well, we're going to be getting more to them. And obviously the chips bill is something that is upping our manufacturing, is going to also really bring like a lot more demand and potentially even differentiate on prices for some of these companies. So yeah, that's one that already has high profitability but low growth. But if the growth starts to get higher for LRCX, then that really changes the game. And that could change how it's valued to be both a highly profitable company, but a company that adjusts its growth multiples up. That could be something that starts to get viewed very differently. So that's another one that if you think you missed the party, and I'm just like, stay away from NVIDIA and AMD. Those are 2 names, especially ASML, that I think could be really good opportunities. One thing that we were looking at this morning is SMH, which is a semiconductor index. And that was even last week. It had a net option sentiment of 46. And I saw it go up to 69. So, towards the end of last week, and today it's back down to 49. So that might actually be something to keep your eye on, SMH, if you're trying to say like, how much juice does the semiconductor AI rally kind of thing have? Like, I'm not saying I'm ready to say it's decidedly bearish, but if you see that SMH net option sentiment go down even further, because obviously that's an index based net option sentiment, that could be a very good leading sign that it might be time to turn around. It might be time to not take new positions. On the flip side, if you see ASML net option sentiment staying well, and if you see SMH kind of go back up like solid more, go back up into the 60s even, to be specific on SMH and kind of level off at the beginning of this week, that might be a really good sign that there is a lot more juice left in these semiconductors. And one other thing that's kind of tangential to semiconductors that kind of goes over some of the cloud businesses and everything else. A company that we've really liked for a long time is SMCI. And actually, when we tweeted about it on May 9th, we said this is a company that we really like. We couldn't quite make it into our newsletter because we love, as I explained, we loved Amazon and Meta so much. And obviously, if our signals like blue chip stocks that are going to like lower risk for people that much, that's important to us. But SMCI has great numbers. It's up over 100% since it scaled up to like the top of our like 80 bell curve for net option sentiment. And since we tweeted about it on May 9th, it's now up close to 75%. So that's a nice thing that even though we didn't get it in our newsletter, we did try to, help our followers on that one. So that's something that, that we are actually going to try to do more of and do more of here when we have kind of new picks. ASML, there's been some good examples. ENVX is one that we still really like that we mentioned in our small caps. We're definitely going to try to supplement the newsletter here and give people some, some additional things to look at, which kind of, I think, transitions well. Oh, should we do retail next or Matt? Well, we'll do retail first and then.
Before we move on, I think there's one more semi stock we should talk about. I think it was MCHP microchip.
Yeah, we looked at that one, and that one was like I would say somewhere in between these, like SML, LRCX is going to be a bit of a smaller one, obviously, so more risk. But yeah, that one, when we looked at the signals, it wasn't quite as appealing as the two that I named. But if you're looking for a smaller one that might still have some room to go up, that one looked, way better than AMD, Intel, Micron, like a lot of the ones that we look at that are signals and the options dynamics are telling us they might be more tapped out than the other ones. But yeah, that's definitely something that we like.
All right, great. Yeah, that was a very thorough semiconductor overview. I hope that helped our four viewers watching this. And you guys should comment if you have any questions. We'll answer them throughout the stream. But I think we can move on to retail, which has just been a dog of the stock market for some time now. It's just one of the most hated sectors out there, probably them and banks. So what do we have for retail?
Yeah, so I mean, I think when we talk about macro, we'll talk about more of like the interactions of this, because I do think these are two sides of the coin, right? Where like you see the market start to rebound, and yet people are just like, well, like these like tech stocks are going up. But what about the rest of the market? And I think what we shared at the beginning, we shared for a reason. Like it's crazy that 3 stocks can flip the S&P 500 from a negative to a positive, even though it's like small on both ends. That's just a crazy idea to me, in terms of like those moving so differently than the market. But the other end of that spectrum is really these retail stocks. And we've been warning in our newsletter about the credit crunch, and personal finance is just going through the roof. And like a quick, like we can go more in, but just like a quick like lesson about like some of these things that interact. And honestly, some things that until I started writing my newsletter, like I wasn't even like as up to date, I would say, on some of these dynamics. Versus, when I say up to date, I mean where I was an economics major in college, and I maybe wasn't thinking about it as much when I was looking at, especially the 12 years I did of more like pure AI predictions. But what I would say is the important thing to remember about this and personal credit going up is that what we're talking about is when we have rising interest rates, and that basically putting a strain on trying to curb inflation, or the inflation that caused those interest rates to rise. Basically, people's buying power is going down with inflation. And while like I think what people need to remember is sometimes people confuse inflation going down and the inflation, the rate that inflation is rising going down, which is what's happening. We're basically saying inflation is rising less and less, which is a very different environment than a deflationary environment. So we are still in an environment where goods are costing more. So when goods are costing more, that means people, for making the same amount of money, because wages aren't rising like competitively, some are, but overall they aren't really. So basically that is, in a way, giving people less spending power, right? And what tends to happen when people have less spending power, and what we see, is that to spend the same amount, they will dip more into credit. And that's why we see personal credit rising. But the issue there is that as we, see the personal credit rise, and people get more and more into debt, and obviously they might get the money now, but those interest payments, as well as rising prices, are going to put even more pressure on them. Now start to talk about the job market cooling, which it has, not as much as some people expected, but we certainly, I think, as long as we're not cutting rates, there might be even another raise in the rate. But people basically say the impact of interest rate rises is felt long after they stop, and certainly until they start to be cut again. So we are going to see more pressure on the job market, and that's why people always talk about the job market. But essentially what we could be talking about is, like, that is obviously less wages going in the pocket of everyday people. That is going to impact what are they going to do less? Spend money in retail places. So not only are they going to start spending money because of the job loss, this credit crisis, and basically like that taking money out of their pockets and potentially causing financial strain, is going to be impacted there. And we've actually already seen that, and that is what affecting some of the retail stocks. Like, perhaps spending isn't like as tangibly down yet, although we are, I think, starting to see some of those forecasts. Target reported $500 million in theft. Ulta Beauty specifically mentioned theft as a big part. We saw their stock down like 12% at the end of last week as a part of their lower guidance. So yeah, that is a very real sign that, that not only are people going to be spending less, but that is an early sign of the financial difficulties for everyday people. As obviously, you say, what's the difference between then and now? Like, this credit being extended, and maybe some of those same people that like credit was their option to spend out of their means, maybe the next thing they go to is theft. Maybe that's a sign of more job loss that hasn't quite hit it, because they're still trying to basically get what they want. Although I guess beauty supplies are not necessarily something that you think about when you think about people that are desperate. But yeah, I mean, not to joke about it, it's a serious situation that I think is definitely going to continue to impact a lot of retail spots. And yeah, I mean, I don't know historically how much theft has happened in these environments. That's something I would actually have to do more research on. But obviously the spending is less. But whether or not it is more, like, those are two different avenues of like revenue loss for these retail companies. And obviously what we're seeing in the market is we're seeing that, perhaps we are still seeing a lot of expectations of a recession coming, but where that recession is being priced in is in these stocks where everyday people are spending, and not necessarily being priced in these, AI companies, corporates, like, where, I think what we've already seen is a lot of these, and we've talked about a lot here, a lot of these large companies protecting their profits by already cutting jobs. These tech companies, they've already cut jobs. They've already created additional room in their forward forecasted earnings. And now with this kind of like additional business forecast being added and this excitement around AI, I think that's basically why we're seeing this divergence here.
Do you think that's the pain in retail is partly the reason why Amazon has lagged the big cap tech stock rallies, like I'd say the most out of the big ones?
Yeah, I'd say so.
You think they
Yeah,
should?
something we still really like. And I like Amazon and AI as well as I like any company. But yeah, I think if you're asking why, a company like Amazon that stands to benefit from AI as much as anyone, and AWS, when you look at AI, like if you're just like, what's the AI business? Cloud. Cloud is what you're looking at. Like, because all of like whether it's Google, whether it's Amazon, whether it's Microsoft Azure, like all of those companies are rolling out more and more AI products in their cloud. AWS is obviously still the biggest cloud provider. So there's no reason to think that they shouldn't have like some, if not the biggest benefit. But yeah, what's the difference between Google and them? And Google has, done a little better. It's that they don't have the same retail business. Now, whether I actually believe how much Amazon is, how much they're going to get hit by this, I don't know. Because I would definitely call like, well, Amazon obviously, and for people that don't know, there's these macro categories that are consumer staple and consumer discretionary. And consumer staple is obviously something that people buy more regardless of the economic conditions. And Amazon obviously straddles both. But what I do think we might see in more cost conscious things, especially as Amazon has moved more into things like grocery products, we might actually see them getting more consumer staple business as people become more cost conscious. They might say, you know what, maybe I don't want to go to my local market anymore, and I'm fine to just get my staples at Amazon because it comes to my door and it's convenient and it's going to be a little cheaper. So that's something that we might see. And obviously, I'm very bullish on Amazon, but I think you're correct. I think like Amazon is something that straddles so many businesses now. And honestly, it's a miracle it's not a monopoly. But as long as it's not a monopoly, we're bullish on it. But
You should split the company and separate the retail and the cloud businesses.
oh, I mean, I think Alibaba just got split into 5 businesses, and cloud being one of them. I don't know. We could look up. Maybe that's a good topic for next week. How Amazon might get divided up, but I honestly just think it won't. And I think it won't for a simple reason. Like Google's a monopoly. Like by every definition of the word, Google's a monopoly. And like more so like Amazon is more of like the kind of thing that got like busted in like the trust busters, like the Union Oil that like owned anything. Like that's like Amazon more like AT&T, like the Bell companies, like Amazon looks more, I would say, like the uh the vertical, integration businesses, or more horizontal integration than those. But Google is like a true classic monopoly that we have just kind of ignored for a long time. And that's the thing, like I just do not think our government is prepared, like with all of like the campaign finance and everything. I don't think they're prepared to take on Amazon and Google. I mean, I think it's probably pretty much just those. Although maybe Google, maybe it's the worst time to do it because they could make the argument that Microsoft is coming for them now.
Mhm.
But yeah, I would say that that is kind of the biggest problem when you like look at that, where it's just like who's ready to take on Amazon is so big, and Amazon is such a big part of our economy, and like the way like campaign finance works now, like they're paying so many like donors and everything. So yeah, I don't know. Like I think there's it makes sense, but also it's just like I also think the other component to it of besides all the things is like people like Amazon. And I like it's hard. Like there's so many people that are just like boycott Amazon. I like Amazon. Like I don't like the way like I really don't like how they treat their workers. But like I can't imagine boycotting Amazon. I use it for everything. I use it for reviews. I use like, and I don't want to be flip around like like their labor practices, which are terrible. Like, but like we're just in this point where like part of it just seems like I have this joke that I do with my friends sometimes that I just like I'll say like what a time to be alive. Like, and it's pretty much just like when Amazon sends me something in 2 days, or like, it's easy to find something on my phone. And the joke is like, obviously, like there's so many problems with the world and society and everything. And like basically we've exchanged a lot of like rights and treatment and like, everything that's happening with the world, and maybe like, us ending up underwater. Like we've traded all that for like, getting the products we want, like the same day. Like, so like I'll say that, but it's like, I do genuinely mean that when I'm just like, when something's a little more convenient, I'm genuinely like, oh, like at least we get something for the demise of the world.
Yeah.
Yeah. So it's just like I think that's kind of how I view it, where I'm just like, like Amazon is like a problem, but like there's much bigger problems than Amazon. So I might as well get my products I want cheaper and faster. So yeah, that's why I just think that it's hard, and I think it feels like too much for everyone. And yeah, I think people would be pissed. That's another reason. If someone was just like, if Amazon was getting broken up and it meant that like we were going to be charged more for like our products and like our Prime membership and things like that, like I think that would be equally as unpopular with like Amazon customers as it was with like senators that they paid.
So basically, the whole game theory behind retail going down is that there's going to be a weaker US consumer in the future. So, how would that not hurt a company? Or I guess it will, but it's not being priced in right now, to a company like Apple that sells an expensive product that everyone already basically has one. So, you don't really need to upgrade it. It's kind of it's discretionary, I would say. So, like what's going on with Apple? How come they wouldn't be affected? I know they're a lot stronger company than retail are, but you think they could go through an entire cycle like that without being affected?
I think there's a few things at work there. Um, I think that Apple customers, A, tend to be have higher incomes. Like that's just the way that it is. I think people that are like, especially in this country, it definitely skews. Like I'm not saying it's not possible to be a very successful person and have a Google phone. I have some very rabid, I call them Google cult members, that would strongly disagree with that. And I don't think that. It just tends to be how it skews in their actual customer base. And I think that is like, I think Apple is looked at similarly to how tech companies and their cost cutting is looked at. Like, oh, like the tech people and the well-off people that that buy Apple phones, they've already lost their jobs if they're going to lose them in these like kind of like purges for the high paying tech jobs. Like the jobs that are still to be cut, I think unfortunately are going to be more like, oh, retail's losing money, so retail is cutting those employees. Like, and those are lower earners, and those are not typically people that buy Apple phones or Apple computers or Apple products. Like, and I also think that Apple's international markets are always growing. They have competition, but anytime a country is forming a new larger middle class, which is like constantly happening in countries that are not the US, where our middle class is shrinking, those are new Apple customers. So I think that's how Apple is looked at, and I wouldn't call that completely wrong. I just don't think that there are tons of people that like, and if that was the case, if you're a lower income person that like buys an Apple phone every like 5 years or whatever, I'm not sure how much like the job market is affecting that. Like the people that are buying an Apple phone every year or whatever, those are people that I would say are higher earners. And as I said, I think a lot of that job market has been worked out already. And like the main thing is I also think a big difference here is like the credit markets and personal credit. And to an extent, even like higher earners could be straight on personal credit. That could be actually something that drives down the sales, especially as some of that is worked out. So that is to say, like, people could be wrong to not be valuing Apple like that. I just gave the bull case. the bear case is like, oh, like maybe those like well-off people are overspending on credit and things, will be hit there. But I think a lot of that is kind of circular with the stock market, where like, let's look at it this way, right? Let's say these high earners with money in the stock market, right? The market recovers. Maybe they even had the intelligence to put more money in like at the bottom. If the market recovers, then they're going to pay their debt off with that market recovery. And there's going to be no issues. They keep buying their phones. The stock market is an earning power for them.
Mm-hmm. Doesn't that
And
hurt
that's
inflation though?
what
Doesn't that hurt inflation though? If like everybody starts spending money again?
that has been. That
Mm-hmm.
has been what has been hurting in inflation. But I think like I hope the government is a little more careful. I hope the government is a little more careful about essentially. I mean, not to get too political, because I think, as I've said, both parties are very bad at stopping inflation, and they've just been spending more and more. And just to be very clear and even, the Democrats passed the Panama Free Trade Agreement, which was basically a tax evasion bill, and then you have this Trump tax cut that both of them put a lot more money in the hands of people that are causing inflation. And then we had like the stimulus package, which further, like, not only like a bunch of people I know directly invested in stocks with their stimmy. I had one friend call it. And but also there's just like there was more money being handed out, more money circulating, everything like that. A stat that I've shared that's just crazy is like, typically corporate profits make up about 10% of an inflationary cycle. In this one, it was 50%. I think a little over 50%. So that is a very real impact. And what we're seeing is, like, while profits were a little down, we're actually seeing a lot of companies just like raising their prices more than inflation. They're basically looking inflation as an opportunity to charge even more than inflation. So that's something to look out for in terms of ongoing inflation. And it absolutely is a concern, but it might be a concern. It might be a concern that we can get on top of. I don't know. Like, I assume, like, regardless of all of the incentives, I assume that it's Powell's, like, Powell might not be, he might be out of office in the not too distant future. So I imagine, regardless of any political posturing or whatever, his nightmare is to be known as the person, like the second person that was responsible for leaving like lasting inflation. So I do think he's on top of that, and he will, like, he's not going to let a stock market party happen. Like, I promise you, that's going to risk inflation. So I think that's why we're seeing it. And because of this stock performance, that might actually get us another raise. I would not rule that out, especially in light of this like kind of bullish performance. But it is going to be very, very interesting. But you're right. That's where inflation becomes a risk. But that's where it's just like very, very hard to look at this macro environment, because there's so many like levers. And I think if there's one thing I am confident of, it is that it's going to be hard to see it run too much one way or the other. I don't think Powell wants it to get out of hand and like go and just like enter another big bear market. Nobody wants that. And his bosses certainly don't want that even more. So I do think if we do see any, like if we see a raise and some bear runs, like, we will see perhaps cuts for sure. But I think if this continues to go up, or if it doesn't go up and we just stop raising rates, I think we could see, like, as some are predicting, many non-cuts, like many flat periods. to manage that. Yeah, I don't think there's going to be a huge bull run as a result, because it's got to be managed both ways, because you're absolutely correct. But that being said, like it could stem like some of these like debt problems that people like, even if there's a slight bull market, that could help people, that could help uh create less of a debt burden. No, and also I think we mentioned it last time, obviously college loans um could start, very well might become due again. And that is something that is another variable here that could like further strain people in this situation. So yeah, it's something to watch for. There's a lot of levers to pull, but like definitely I would stay away from retail stocks for the foreseeable future, because like those estimates can just keep coming down, especially if this like there's a very important economic theory. I don't know if you're familiar with it, but it's from Freakonomics, and it's the tipping point. I don't know which one. I always get those books confused. It's one of them, but it's called the broken window theory. I'm pretty sure it's Freakonomics, but it basically says that like, they stopped turnstile jumpers in New York by cleaning up graffiti. And that was like subway turnstile wires. And that's like where like the broken window theory, I mean, people said it, but basically there could be a broken window theory on this shoplifting. And I'll we'll see what happens. But basically, like if people are finding out that other people are shoplifting, and like and that's a thing, we might actually get a lot more of it happening. Because they say, oh, people are shoplifting, maybe it'll be easier for me to get away with it. So yeah, like I like, if we're talking about a broad pair trade, like, and just the things that we talked about, because I think like, like going long semiconductors or the QQQ or whatever, and like short retail. Or maybe we'll talk a little bit more about that pair trade next week, because I think that could be an interesting thing to come with ideas unique for this. That's like, that could be a very interesting way to make money, because I don't like, I think that if you go both directions, it's going to be hard not to make money as I see it the next 6 months. Just because, like, let's say tech is neutral or a little down, even with this AI craze, it probably means retail is going to be down that much more.
If retail keeps getting killed, is there a point at which you would say it's priced in and it's ready to be bought?
No, like not like here's the thing about like me being trained as a value investor, and what I learned. Whereas like value is always relative, and like it really depends on where the other stocks are being valued. Like it's possible that like just like PEs are hammered as a whole. Like, yeah, there could be a relative value, but it's hard for me to speak to that, where it's just like, oh, like retail traditionally trades at this PE multiple versus like, let's say industrials. That's something that I would kind of see unaffected by this like tech. Like, and it's just like, oh, like if it's like, let's just say like, I don't know this number, but like, let's just say it trades at like, 1 to 2. Like, but then it goes like 1 to 4. Like, yeah, that could be something that makes it interesting. But the other part that I just can't speak of is like how bad the credit crunch gets. I don't want to sit here and like say like, oh, well, it goes to 1 to 4, like we're in. Like, it also depends on like how bad it actually gets, because the key to value investing is saying what is priced in. And one of my favorite stories is that like Warren Buffett basically says his biggest regret was not investing in Amazon. Or maybe he doesn't say his biggest, but one of his biggest regrets is not investing in Amazon. And when I learned about value investing, it's very funny. I'm going to date myself. I first learned, I worked in my first hedge fund when I was 17, and taught myself accounting to get that value investing job. And there, the official line for value investors, let's see, what year was that? That was 2003. Oh, no, that was 2003. The official line was, value investors don't invest in tech stocks, because we don't know what growth multiple is built in to the stock already. Like, and Buffett had a very, like, you could look at it and it's still hard. It's still hard to do that, but like basically everybody, like after this, Buffett, like, who's the godfather of value investing. Now, maybe Ben Graham is the godfather, but he's basically like
That's
the main value investor now, the president. What's the equivalent? Yeah, basically he and Jeff Bezos offered him a discount to where the stock was trading. And Buffett was like, these growth multiples are crazy. I can't even at your discount. Like retail investors will pay for that, but like I won't pay for that. I don't pay for those growth multiples. And these are crazy. And Bezos like far eclipsed the growth multiples because like Buffett just didn't. Tech is a different animal for how fast it can grow versus traditional business. And Moore's law and everything like that is a very interesting thing to Google if you want to look at that, like what actually like might be behind that. But it's really funny because Buffett is basically I've never been so wrong about something because like Bezos was actually giving him a good and very reasonable deal. And Buffett's response was basically like, okay, retail investors are always stupid. They don't know how to value things. I do, and I don't pay these growth multiples. But basically, like later on, he realized what a mistake that was because tech was becoming such a big part of like investing and the future of the world and everything like that. So he had to it's one of I don't know. Like I've studied a lot of the history of value investing. Maybe it's the only thing I'm aware of where like value investors had to like change their tune about something because the whole point about value investing is it's supposed to be like objective. And it's like, if you're at this earnings multiple, you are a good deal based on like your free cash flow. Like, and that's it, no arguments. But it's had to expand. And in expanding, it sort of made me be like, well, I don't even know what that is anymore, to be honest. And that's why I lean more on tech and AI myself. Because like once that blew up, and once I saw some of my own like pretty like bad, dark stuff in finance, anyone who's been very close in finance has been around when I'm just like, oh, I don't even know if I believe in this anymore. And that was one of the things that made me lean more on tech because like there's algorithms in my formulas that I can trust a lot more than a PE ratio. That like for the reason that we're just talking about, it's like so relative, and the formulas that I build and the ones that I pass on to our users, they're meant to be things that stick, and that if someone sees a high upside breakout, we stand behind an expectation that stock will do better long relative to the other stocks in the market. And that's what we've tested it for.
Yeah, I'm sure Warren Buffett's sleeping pretty well with that Apple position after missing out on Amazon. I think he owns some insane amount of Apple now. It's like 5% or something. It's
Oh
like
yeah, I mean,
hundreds of billions, his position. It's insane.
yeah, I mean, actually, there was a time with Buffett that for those that don't know his history very well, one of the smartest things he did that made him who he is was he bought Geico, and he like pioneered investing insurance float. So basically what that means is like when you pay your peer premiums before like insurance is like paid out to you, that's called float. And like typically insurance companies will like make their little like annuity return on your float or whatever. They'll make their 6% risk adjusted a year. But Buffett was like, screw that. I can make a lot more than that with this float. So he actually invested the float and he insured it, and he's very good at doing that well. But he pioneered that. That was like one of the first things he pioneered. Now like all insurance companies like invest more aggressively, some more than others. But the thing that actually like too late in life, I would say, occurred to me about like how good his investments are, and this is like another thing that makes me say, oh well, like value investing is like, it's nicer if you're Buffett. But like when Warren Buffett buys a company now, it goes up, like, because he's smart. But the other thing that I didn't even realize, I was like, it just like came to me one day. I forgot when, but it was just like, oh wait, like Buffett helps these people run the company too. like he buys the company, and all of a sudden, like one of the smartest business minds like you've got with all these connections and everything, he's helping you run the company better, and he knows everything about that. So like that's one of the reasons that Buffett is such like a self-fulfilling prophecy. Not only do people just like momentum invest after him and buy when he buys, but like him buying it is just the start. Then he's making sure he gets a return on investment. And he's helping you run your company better. And Buffett often says like, oh, like good management, like, and he's right. I'm sure he has an amazing process for picking good managers, but I'm sure some of that process is how much are these guys going to listen to me?
Yeah.
Like, how much are they going to take my feedback? How much are they actually going to accept me helping to run their company?
I just looked it up. He's 92 years old and he's still doing it. That's crazy. I feel
Wow.
like he'll never stop at this point.
Yeah, I don't like, no reason not to. He eats McDonald's too.
uh,
He likes a McDonald's breakfast.
I was reading an article the other day and I made a short video about it on my other channel. But so getting into next topic, the debt ceiling being raised tentatively. Before that, or I guess it hasn't been yet, but before this agreement even came to place, Berkshire Hathaway, Google, Apple, and Facebook all had more cash on hand than the US government. How crazy is
Wow.
that? And a lot less debt too.
I didn't know that. Wow. Yeah. I mean, obviously they don't have the same capital raising capabilities.
Infinite.
What's the valuation of the US government? I don't know. Can you buy equity? That would be an
Should
interesting
all
new
make an
way.
offer.
That would be an interesting new way to raise money. Just like having an IPO for the US government.
Oh my God. I
I'm
can't.
sure China would buy up so many shares.
Yeah, right.
China would be buying up like so many shares. They own some debt. They want to get a piece of the equity position. Um, no, it's crazy. And it's just like at some point, it's just like we're cutting our tax revenues. I mentioned like there's so much tax evasion. Like the new advisor that I mentioned, one of the first things that we talked about was tax evasion. And it's just like, it's crazy, but it's just there's such structural problems with what's going on. And we just have like crumbling infrastructure. We have less and less like appetite to make laws that benefit people. And like benefit anyone more than like the 1% that they're seeing a return, they're seeing like everything else. Like one of the craziest um I think one of the craziest stats that I saw was like, and I don't know the exact numbers, but it basically talked about like the Koch brothers and like how much they saved from the Trump tax cuts over the next 10 years. And I think it was like something like, I think it was something like it was something like they did like over 100 million in like political lobbying. And then they were saving something like over 500 million in taxes. So like that's what I was like, oh man, what a return. Like if you're giving like an ROI on political lobbying of like 5x, like you're never going to stop that problem. Like and you're just going to have more and more people like doing that. So yeah, like it's like hard to fix the problems that we have and like the way that everybody like panders to everyone else. It's difficult because there's no like, and when you have an industry like coal still going, like when like it really shouldn't be, and you have all this lobbying around it, and it's just like that's what happens because like our elected officials are so afraid to piss off their existing donors, even if it creates more money from new donors and bigger businesses. They don't even have the foresight for that. That you basically just have like this idea that like nobody wants like they want to piss off people so little and affect their base that like we can't really pass any new laws
They
because
become
any new law, what?
they become a puppet because
Yeah.
they're controlled by the
Well,
money.
yeah, but any new law like is going to shrink someone else's business or most and increase someone else's. But no, it's just like it's even like poor foresight, because like if they worked more like people in industry, right? And they like were smart about it, they could say like, hey, like solar companies and renewable companies, like we make this much money from oil. Like if we promise, like if we promise to like strip oil subsidies and put it into renewable subsidies, will you make up that difference? That's how like a business person would think, but they're not really business people. And they don't like, and the problem is, and it's like it's a problem in business when you're far away from this, and it's easy for me to say, but I understand like the functions of business well. Like they're all friends, and that's what it comes down to. And like you're getting money from these oil people, but they're also your friends, and you don't want to screw over your friends. And that's like it's a big problem when your friends are, polluting the environment and holding back the progress of humanity. But like it's easier said than done, because like there's a lot of people in this world whose friends could be holding back the progress of humanity, and people would not be willing to have tough conversations with them around especially their wallets. But yeah, like it's not like it's something that other countries have managed, like Germany like has done incredibly well moving to renewable energy. And it's just something that we can't handle because we don't seem to have any way to break away from existing donors, or people don't seem to have any way to do that.
Would you like to see more people who are business leaders transition into politics later in their life since they know how to operate an organization?
Yeah. I'd love to see that. Like I honestly think like there are some problems with like Mayor Bloomberg in New York, but he was one of the better elected officials I've interacted with. I mean not personally, but just like whose policies I've interacted with.
Mhm.
Um, and yeah, I mean I just think like honestly my favored solution, I think elected officials should be paid much. Like
Mhm.
that is, I think, the easiest, cleanest, simplest solution. Because right now, basically, to make the same kind of living that other people do in other industries, like you have to be corrupt and you have to trade stocks and you have to do this because, like, people with that much power are going to find a way to turn that power into money. It's just a reality of the situation. You can't pay like if all of a sudden you made all these teachers senators and like and kept them at the same salary. I'm sure many of them would become corrupt pretty quickly. Nothing against teachers. I'm just thinking of like a low paying,
Mhm.
like public employee who probably have like very different value systems. But at the same time, there's just like, it's a series of small compromises that I think are made, and nobody like wants to be evil. But I think you're just like, oh, sure, like I'll trade this for some votes or like whatever, or like, sure, it sounds like what you're doing is like going to be ultimately good for the country or things like that. Um, but I do think um if there was kind of salary that was higher, you'd get the kind of people that actually wanted to make change um and didn't necessarily like weren't basically like going to be like, oh, like, well, I'm not going to make much money here, but I have a lot of power. I think the current political systems attracts people that know their money is going to be made in corrupt practices or organized, like, I say corruption, but it's not even like illegal. It's like legal corruption or legal cronyism or whatever you want to call it. And I don't even mean to suggest that it's illegal what they're doing, or that it's like, or that non-illegal things are, wrong, but it does feel morally wrong to a lot of us, especially like when everyday people are being taken care of less and less.
It's certainly a fiery topic, and I'm happy that we're bringing light to it and calling it out. But we're getting to the end of the time here. And you have an interesting Twitter Spaces, I believe you're going to do tonight. If you want to mention what that's all about.
Yeah, we are going to talk about AI and investing, how to use different tools, a little bit more about some of these AI companies. So yeah, it's at 7:10 p.m. Eastern time. You can find it on our Twitter page. Wolf Financial is going to be there. Stock Market News is a very big Twitter account. Corey Arnold, who's one of someone that we actually work with on some posts. And so yeah, I think it's going to be really great. There's going to be a lot of new ways on how to use the system, and we'd love it for you all to join.
Awesome. We'll be sure to tune into that. And sad we didn't see Philip this week, but maybe
We
next.
lost him. Maybe we should have answered his question. Well, he didn't answer a question.